Well, good morning, John. We're recording this on Thursday morning, and this follows about 3 weeks of pretty volatile and declining markets. And I think a lot of people are a little unsettled by the events of the past few weeks. Our market has entered into, perhaps we can call it correction territory, falls of more than 10%. Although, to tell you the truth, this hasn't really come as much of a surprise to us because we've talked so frequently about parts of the market which are seriously overvalued. John, is this a period during which we need to reflect on our exposure to equities, or is this just part of investing in the share market?
Well, both, Paul. It's an opportunity if we can identify stocks, quality stocks, which come back to somewhere near value, and I think that process is underway. So our investment team is onto that. Yield is appearing in the stock market. I think that's important. As the banks pulled back, yields for Commonwealth Bank 3.5%, the other banks 4.25%. As we see yields for the other banks, I'll call them, head towards 5% franked, well then there's probably a natural floor on that part of the market. The trading part of the market, the export part of the market, even though it's not big, outside resources, there's obviously some question marks there about where we head. And from an Australian perspective, we've got the election. And just this morning, Paul, we've had an announcement that electricity prices are going up, at least 5% at retail level, maybe higher. And last week we had health insurance premiums going up. So Australia continues to kick lone goals in terms of its fight against inflation. So we are making it harder for ourselves in this country.
Yeah, a couple of things to address there. Overnight, the US inflation number came in a little bit lower than expected, so that's good news. I think the markets were expecting the CPI to be at 2.9, came in at 2.8. There was a bit of a relief rally on Wall Street, but it's hardly a convincing turnaround to what's been pretty negative sentiment. We can come back to that, but I also want to just address this tariff issue because Trump has obviously put on a 25% tariff on steel and aluminium across the whole world. And in Australia, politicians have made a huge thing about that, but the reality is our steel and aluminium exports to the US only amount to about $1 billion a year. Put that in the context of all our exports of goods and services, about $650 billion a year. So hardly seems a reason for our market to be, taking such a negative view of the impact of tariffs.
Yeah, look, markets are strange things. They get bid up for obscure reasons and they get sold down for obscure reasons. And you only need a trigger point or a trigger event, and the tariffs and the geopolitical upheaval issues across Europe and Ukraine, you just need that to trigger it. And that's the black swan event, which we've always talked about, Paul, what's going to pull the market back to reality. So we're going back. I think it's a reality check, which is good. If you want to buy the market, you're getting a better value than you were getting 6 or so weeks ago. So that's the good news. Whether there's a quick fix to it, I doubt. I think there's a work through here because we're dealing with an administration which is throwing policy out there almost in a whimsical way and with a very strange view. I think they hold that there's not going to be any reciprocal payback. And we've seen overnight, Paul, some quite significant tariff increases directly directed at states which are Trump states, cross-border from Canada and from Europe, really targeting areas which are going to make Trump very uncomfortable. And I'm surprised he didn't see that as a possibility in terms of strategy, but it does lead to the point, did he actually have a strategy? Did he actually think through the consequences? So I think there's going to be a lot of negotiation coming out in the next few months to unwind a lot of these decisions, but it's painful to watch.
Yeah. And John, the last time the market took sold off was in 2023. And at that time, one of the catalysts was bond yields moving up towards 5%. And I remember us speaking about that pretty extensively. This time around, though, the bond market has really behaved, and US 10-year bonds are around, 4.3, 4.4. So it seems the market is really more concerned not about inflation, but about the possibility of tariff uncertainty causing a recession. Do you think that recession is still, a real risk for the US economy, or is it just a change in narrative that'll change again in, 2-3 weeks' time?
Look, if he doesn't pivot, and I'm sure he will, recession is not just a possibility, it's more likely than not. You can't disrupt the trade markets of the world, create inflation, and not expect a consequence. So that's the problem with this, Paul, is if you actually believe he's going to continue with this policy unrelenting for a year or so, then he will more likely than not cause a downturn in the American economy. If you believe that an entrepreneur like Trump will do that, then that's another, I'd say that's more unlikely that he won't pivot. Okay, he'll see the consequences. He's driven by business, he's driven by profits, he's driven by the growth of the American economy, the stock market. That's his KPIs. So he will pivot. But as I said earlier, it's painful to watch because we are speculating on him, and it makes it very hard. And you can see he makes decisions on the run and changes those decisions on the run. I keep on saying it is like watching a TV show, but it does put into focus Australia. Who's leading Australia? Who's going to lead Australia? What is the policy? And we've got this, I keep on talking this diatribe about, well, who talked to Trump and why didn't you go over there? Can we get away from that nonsense? Yes, America is important for defence. It's not important for trade. Okay? It's become excessively important for investment returns. And that's something which should come into focus more quicker than it is. We've had major reports in the AFR this week, which we've been saying, Paul, for months, that the defaulting of Australian superannuation funds to international markets, and 70% of which is going to America, is putting us in a high-risk position. Now, it's not going to happen, but I just speculate. If Trump's going to make these crazy decisions, at what point does he freeze international capital inside the American market? At what point would he say, I want to freeze the free flow of capital? We are playing a very dangerous game. Now, we had a superannuation delegation go to America 2 weeks ago. I don't know what they were talking about, but it should have been obvious that we are an outsized supplier of capital to the American economy. Outsized. Given our GDP, we invest in a significant amount of capital. And it's absolutely incumbent now that we start rethinking where we direct capital. And if we were going to have a discussion with the Trump administration about the future, we should have been flagging the risk that they are putting on themselves that we withdraw capital. Now, that's a very big comment, and the government doesn't want to talk and direct capital, but we are being flung around here as a small player, and we're part of a very big region, Asia Pacific. And the opportunity north of Australia is much more significant than the opportunity east of Australia. And it's about time as a nation we got onto the front foot and direct our future, not only in terms of defence, but also in terms of trade and the ability to generate wealth in this region. Yeah.
It's a good segue to talk about valuation. So during the recent sell-off, the price earnings multiple of the Magnificent Seven, the seven largest technology stocks in the US, has gone from 30 times, which arguably is expensive, down to about 26. So maybe it could go a little bit further, but these are world-beating companies. At the same time, Australia's PE has gone from about 18.5 down to 17 times. You refer to opportunities in the region. I noticed that China is still only on 13 times. So obviously, there's a lot of value to be had on the Chinese stock market. Where do you feel Australia stands in all this?
Well, I mean, as I said earlier, the yield on the Australian market's going up by default because the stock prices are coming down, and in one area where there's been a sharp correction is being the banking index. So, we've had some of the banks drop 10 and 15%. And that's not because of ex-dividend, that's just the fall in the value of those banks. So their yield has jumped up substantially, and I think there's a floor coming. But they're not high growth stocks, they're just high yield stocks. And now their yield is more appropriate to take that on board. So that's an interesting opportunity. The resource sector is still benefiting from, despite what people are saying, elevated resource prices and a very weak Aussie dollar.
Yeah.
And the issue about which I just mentioned about the diversion of capital into offshore markets, particularly US dollars, the constant selling of the Aussie dollar is a windfall for our resources sector. So whilst they're not growing profits greatly, they are very well underpinned by the weak Australian dollar. And I think the behaviour, and I know we've got the trade issue, Paul, but I think the behaviour of the Trump administration in dealing with Ukraine really backfired. And I think confidence in the American administration dropped substantially then, and the way they were handling these geopolitical issues. Now, if they get a peace accord in the next month, well, okay, well done. But I don't think they are. They may get a ceasefire. But then all of a sudden you get the thinking part of the world and the providers of capital, the controls of capital going, do we really like what we're seeing in America? And it won't take much to upset the apple cart in the American stock market. And we've seen the crack. We haven't seen the crack in the bond market. Okay? But if Asia can disengage itself, either intentionally or by direction of America, I think this is going to backfire. I think Asia is going to become a tighter trading unit, and Australia will benefit by being part of that. And we also benefit by being a great place to visit, a great place to be educated. Okay, so the outlook for Australia is not bad; it's better. And as you say, maybe we're getting a little bit too negative, but let's reflect that the stock market was very fully priced.
Yeah.
And it was stocks there which were ridiculous prices. And that's an effect of too much money being put into super and too much money defaulting all over the place and defaulting into large cap stocks in Australia. It's time to take a deep breath and reflect, and then try and get some direction in this country through the election and coming out of the election. But as I sit here and listen to the debate, it's sadly lacking in any vision in this country, which is probably the big negative to what I was just talking about.
We do have a second part of this this video, which is Stephen Lambeth, our senior portfolio manager, is going to be talking about specific Australian stocks and the opportunity for Australian companies in the immediate future. So I think we'll thank you for your comments this morning, and stay tuned, and we'll have Stephen joining us momentarily. Thanks a lot.
See ya. Thanks.
So let's keep moving. What about Australia? Well, Australia's an interesting market to the extent that for some time we've been flagging that there is a challenge out there for Aussie equities, because earnings growth it really has to be the leadership of the market, given the context and the backdrop of elevated rating and lack of yield. That's what's shown on the bottom two charts there. So ASX PE, as I mentioned, currently around 17.5 times, has been more sort of 16 times historically, and the dividend yield has really collapsed down to just over 3%. So if it's up to earnings, well, we've just had the February reporting season. What did we learn from that, and what does that say about the outlook? So let's just jump straight into that. This is fairly busy, but I'll try to keep it simple. We stock take all of the results and tabulate what number of companies had an upgrade versus what number of companies had a downgrade. Not all companies reported, of course, but there have been goings on with trading updates. For some, there have been other developments to mean we've got a fairly full picture of what happened to the ASX 100 over the February profit reporting season. And in the table on the top right, you can see that we had a fairly even balance of those stocks with upgrades to the FY25 outlook versus downgrades. There was a slightly different story for the ASX 200, however. So if you were to look across the 200, there was actually a lot fewer upgrades relative to downgrades. So the message there would be the small cap sector hasn't had as good a time as the large cap sector. And that also played out in average EPS revisions. In the case of the ASX 200 overall, around about a low single digit decline. So where does that leave us? On balance, a fairly benign reporting season that sees not a lot of change to forward growth estimates. Courtesy of Macquarie, in the bottom table on the right, you can see what growth is being forecast. We are now in March, so the June fiscal 26 year is front of mind, and growth is currently expected to be about 6%. That's underpinned not by banks, which are expected to move sideways to down. It is being underpinned in large by the industrials, both domestic and international. And as for what happens to resources, they've been through a tough time for the last 3 fiscal years. Much of that is just hinged to developments in iron ore and other commodities and the goings on in China. Okay, so that was the macro. We have a cautious outlook. We're looking for earnings leadership, but what's happening with our high conviction 25 stock portfolio and how it's performed? So I've just put on this slide here a simple picture of our performance measured 1 month, 3 months, 6 months, 1 year, and longer term. And the key point to make, and I should just note, these are not completely finalized figures. We're just awaiting on that from admin, but they are representative. And the point I'd like to make is, you might recall we had a very difficult 2024 year from broadly 3 factors. Firstly, with all things growth in what is Climb looking for value, we had the wrong positions on from a style perspective. Secondly, we've been underweight banks, and we remain underweight banks. And as I showed earlier, banks had a very strong year. They were up 30% in 2024. And finally, we also had some stock misses in our portfolio that all manifested in underperformance. But the good news is we now have all those 3 factors working in our favor again. We've seen growth stocks stall. We've seen banks have a fairly underwhelming reporting season, and we're now seemingly seeing the banks sell off. And then finally, and I think most importantly, we've had changes to the portfolio that have seen us arrive at a set of results over earnings season where we have more winners than we did losers. So I just might touch on those 3 themes very quickly now. Value versus growth. I'm not inclined to get too carried away with these high-level thematics because everyone wants value. And so these style definitions aren't really how we size up what we want to be invested in. But they do provide some instruction, because if you just look at the chart on the right, this is quite illustrative of how it's been challenging to get involved in some of the high quality companies with great attributes that we want to be involved in the last 12 months, just due to very excessive multiple expansion that is hard for us to explain on fundamentals. So across each of those names there, that's more or less a list of platform stocks. People talk about AI and tech. I just describe them. These are platform companies that all overachieved last year. They delivered solid earnings progress, but their performance was turbocharged by very significant multiple expansion. And where that leaves us is we did not have capital put to work in these names, and therefore did not get the sort of performance you would have got had you put some capital to work in these names. To the extent through reporting season, all of those names printed growth, but what we saw was some sort of stock take. Well, is this growth enough to justify the price that's being paid? And it seemed as though a number stood up with not enough acceleration in their growth or not enough delivery and surprise to sustain their performance, and they've since come unstuck. So that's worked favorably for us. The second is the banks I mentioned. I don't like talking at length about the banks. They're well researched, they're well understood, they're large, they're mature. I just wanted to point out that, again, as a reminder, top right table, it's busy, but in the yellow highlighted line of that table is just what the banks did in calendar 2024. They rose materially, they rose 28% over the year, and that represented a very meaningful percentage increase of the total market cap growth of the ASX 200. So that concentration was most unhelpful for us, being underweight. And you can see, just as a simple comparison, CBA versus JP Morgan, we are in a different place in how banks are rated versus other markets. There's every reason to unpick all the idiosyncrasies, but the fact of the matter remains, multiples look very stretched. So we are persisting with our underweight. We can't see the multiple expansion justified by growth change. It would have to be some sort of risk change. And that's hard to fully contemplate. So we are staying underweight banks and feel like we're on the right side of what now looks to be prices reconnecting with fundamentals. And just lastly, this is also very busy, so I won't go through it all line by line, that this was our simple reporting season scorecard where each result coming through across the portfolio, most names reported. There are a couple that have March and September year ends, but by and large, we had the majority of our stocks in the portfolio have a result, whether it was a quarterly, half year or full year. And the good news is, in the sort of center of that table, you can see what is a qualitative and subjective score. Either you get a tick for a good result, you get an equal sign for an inline result, or you get a cross for a miss. And the message simply is we had more wins than we did misses. And usually, because you get a large injection of information that really sets the scene for the period ahead, it puts the portfolio in good stead over the next period until we get another wave of results. So they're the three changes that have worked for the better. We've not seen growth continue to overachieve. It's more balanced. We've seen the banks come unstuck a bit. And we've also seen betterment from our hit rate in the portfolio in terms of winners versus losers. Just to finish up, so portfolio positioning is currently we remain underweight banks, I mentioned. We're underweight the big cap miners. Instead, we have a preference for gold. We have healthcare in the portfolio, and we also have a not insignificant allocation to real assets, which is quite different to the market. We're also underweight tech and ultra high PE, as we mentioned, and we still have about 8% cash to deploy. So we are open to opportunities. We are not screening for low PE. We are not screening for high yield. We are screening for opportunities to be attached to companies with winning attributes that we can purchase for you at the right price. The single biggest risk you face is paying the wrong price. We want to make sure we pay the right price. So the current setback to equities is quite favorable for us because we have dry powder to deploy should the sell-off get more untoward. And just lastly, this is our conclusion. I'm being repetitive now, so I'll be quick. We're cautious. We see prices as having still gone a bit beyond fundamentals. We can't rule out a normal return for the year. That's quite possible. It's just that the hurdle's relatively elevated given where yield is, and earnings are generally in a sideways pattern in Australia. So the message is we are seeking to continue to position differently to the market, and we're also seeking to be selective. I'll leave it there. Thanks very much for your time, and we'll talk to you soon. Bye-bye.